I recently worked with a first-time home buyer, and they're like most people today. They were trying to figure out whether to take a fixed rate mortgage or a variable rate mortgage. And I'll tell you, oh my God, they did a bunch of research. And at the end of the day, they were still unsure. So I wanted to break it down for them in a way that was really easy to understand. So we started talking about just the basics, how a fixed rate mortgage works. So a fixed rate mortgage means that the interest rate is locked for the entire term. So if they chose that 5-year fixed rate, then their payments would stay exactly the same every single month, no surprises. Whereas a variable rate mortgage, on the other hand, is tied to the Bank of Canada's overnight rate, which can go up or down. And so if the overnight rate changes, their interest rate is going to change too. And depending on the lender, their payments might stay the same, or they might go up or down based on the new rate. So there's two different types of products there. One where it's a fixed payment, and another one where your payments rise based on the rate. Okay, so I explained to them that if their payments stay the same, when the rate goes up, then more of that payment is going to go towards interest and less towards principal. That's a bad thing in my opinion. But when the rate drops, more of the payment will go towards principal. That's a good thing. So then what I want to do is I want to actually show them how have these mortgages performed over, say 25 years. So if you see the chart on the screen here above me, what you're looking at here is a 25-year average comparing both of these. So if you look up here at the chart, you can see that the 5-year fixed rate, that's the purple line, and the 5-year variable rate, that's the light blue line. You can see that from January 1999 to February 2024, that variable on average has been lower. You can see that clearly here. It's lower, right, than the purple line. So over the past 25 years, the average fixed rate has been 5.21%, while the average variable rate has been approximately 5.15%. So historically, variable rates have been the cheaper option overall. But I want to make sure to explain that just because this is how things have played out in the past, it doesn't mean that it's going to be the same way in the future. It's just one thing that they need to consider and that to help them make a decision, okay? After that, we want to talk about where rates are today. So as you can see on the screen here, this is the Bank of Canada's website today. I pulled that this morning, and the overnight rate is 3.75%. So that's going to set the lender's prime rate. So let's say we have a lender that has a prime rate of 5.95%. And here's a pro tip here. Not all lenders have the same prime rate. So you might want to check that before signing your mortgage agreement. But as we know, lenders want to stay competitive. And for example, one lender might offer a discount of say minus 0.50% off of their prime rate, which means if their prime rate was 5.95%, then the new rate for that client would be 5.45%. So how does that compare to fixed rates today? Well, fixed rates right now are in the low to mid 4 range, and variable rates are at 5.45%, as you can see. So variable's a little bit higher, all right? And one thing I want to point out here is that, I don't know if you noticed it, but fixed rates are actually lower today, if they're in the low to mid 4s, than the 25-year average, which is 5.21%. And if you're one of those people that are sitting on the fence thinking about whether to buy a house now because of rates, maybe that's something you should consider, okay? So let's go back to the variable. So let's say someone had a variable rate mortgage today with that discount of minus 0.50%, okay? So let's break it down if someone had a variable rate mortgage product where the payment fluctuates, okay? So let's say today they had that discount of 0.50%, so their rate's 5.45, and they have a mortgage of $500,000. Their payment today would be $3,023.18 per month. Now, let's say that by summertime, the rate drops to 100 basis points, which is 1%, okay? So their new rate would now be 4.45%, and their new payment would drop down to $2,738.54. See how that works? Pretty straightforward. So when the rate drops, the payment drops. And it could go the other way too, so you got to keep that in mind. So if the rate went up, the payment's going to go up. So the other thing to note that's different between fixed and variable rate mortgages is prepayment penalties. So this is something we need a whole other video to explain, but it's worth mentioning here. The prepayment penalty for variable rate mortgages is usually much cheaper than a fixed rate mortgage. And this is a big advantage if someone is thinking they might have to break their mortgage early. So just something to think about. Finally, what we want to talk about is what are the people much smarter than me predicting is going to happen in 2025. So I'm going to share this one here. This is from RBC, and here's what they're predicting. So according to them, the Bank of Canada's overnight rate is expected to drop to around 2% by mid-2025. You can see that clearly right here. So if that happens, the prime rate will drop too, which means variable rates could start to come down, potentially making them a lot more attractive. But here's something else to consider. Fixed rates offer something that variable rates don't, and that's certainty. So with a fixed rate, you're always going to know what your payments are going to be no matter what happens in the market. So after explaining all this, I told them the most important thing is this. There's no one size fits all answer. It really just depends on their goals, how much risk they're comfortable with, and or if they want just the peace of mind of predictability of knowing what their payments are going to be and that they're not going to change. So fixed rates are a great choice, especially right now when they're lower than that 25-year average that we talked about. But if they're okay with a bit of risk and they like the idea of potentially saving some money if the rates drop, well, that might work for them too. In the end, I'm happy to say the clients were able to make a decision that felt right for them because they understood all their options, right? I take the time to explain everything for them, but it's their decision to make. And that's how I want everyone that I work with to feel. I want them to feel confident and informed about making decisions about their mortgage. So if you're unsure and you're in the same situation and you want to talk mortgage options, please reach out. I'd be happy to help. Bye for now.